Perry International Capital Partners portfolio. It's changed a little bit from last week, but not much. The themes remain the same. I think that interest rates are still stimulative. Monetary policy, that's Fed policy, is at 5.5%. It's been at 5.5% since last July. The Fed last hiked on July 26, 2023. And they've remained unchanged for that entire period. And what's unusual is that, at the time of the last hike, the market was expecting 6 or 7 or 8 hikes by now, right? We've gotten none. Yet at the same time, since July 26th of last year, the stock market's up 20%. You would have thought, with the Fed not changing policy and the market having to kind of reprice itself to that truth, the stocks would have been down maybe 20%, and they're up. So something must give. What gives? Well, what gives is that fiscal stimulus as well. And the deficit's $2 trillion. And it looks like, if you look at the numbers, there's been about $11 trillion spent since the pandemic directly from the government into the financial system and the real economy. So that's why we're still here. The government likes inflation, and corporate America likes inflation. And whatever corporate America likes, Wall Street likes. So the theme and the narrative is that we need to get lower rates so that risk assets continue to rise. You'll hear that all the time. It's a bias. Our job here is to make sure that we kind of cut through those biases. Independent, objective, non-biased information, which is critical thinking. If you gravitate to one narrative or the other, you're going to make an investment mistake, because emotionally trading on things that people angry or make people happy is a good way to lose money. So anyway, the portfolio is mostly bills and money market, about 50%. It's about 30 or 35% equity market. Most of that equity exposure is based on companies that will be supportive of the artificial intelligence industrial revolution, which I do believe is real. I think the amounts of money that are being spent on it are phenomenal by the private and public sector, and I expect that will continue for the second half of the year. So you gotta have positions in stock, but you don't have to have a position in the old Dow 30 stocks. Most of those stocks are really not doing that well. Manufacturing is not a strong point to the United States. It's not going to be anytime soon, and what does come back from China to here is going to be expensive. So I think that profit margins in some of the old line industrial companies in this country are going to be problematic. This is a service sector economy, and service sector wages are driving inflation higher. So we've got a stagflationary scenario. Growth 1%, 2%, maybe 3%, depending on stimulus. And inflation at 3% and maybe 4%, depending on stimulus. So if you've got inflation growing faster than GDP, and wage inflation is growing faster than inflation, your systemic structural inflationary pressures are real and perpetual, and probably get worse before they get better. Okay? Last portion of the portfolio obviously is commodities. A lot of people have different opinions about that. I own energy and gold and some materials that are going to be required for the industrial revolution, which is AI. There's a few ways to play that. Be happy to talk about that on an individual basis with whoever would like to at any time. Okay, thank you.